So, I want you to imagine for a second that you are the chief financial officer of a really massive construction subsidiary, right?
hmm
And you are based right here in Mumbai,
Okay, setting the scene. I like it.
right? So you have just spent weeks, I mean, maybe even months, meticulously closing your books for the financial year. And everything is perfectly aligned with local Indian law. Your statutory auditors are, relatively happy. And your team is finally breathing this massive sigh of relief.
A rare moment of peace for a finance team. Yeah.
Exactly. But then a priority email pings in your inbox. It's from global headquarters. Maybe they're sitting in London or New York. And the message is just brief and totally uncompromising. It says, attention all subsidiaries. We are changing our global revenue recognition policy for construction contracts. Transition to the input method immediately to ensure global alignment.
Oh, wow. Yeah, that is the email nobody wants to get at your end.
Right. So what do you do? Do you just obey the boss and blindly flip the switch on your accounting systems? Or do you push back? Do you try to honor the objective, on-the-ground reality of your local contracts? Because today, we're exploring why simply saying yes to that corporate email could actually trigger a massive retroactive accounting disaster that might honestly haunt your finance team for years.
It really is the ultimate tension, isn't it? That push and pull between corporate compliance and statutory reality. And it's a scenario that is literally playing out in finance departments across the country right now.
It absolutely is. So welcome to a new deep dive on the Gap Advisors Ind AS Clinic podcast. We are so thrilled to have you with us today.
Very glad to be here.
Yeah, and whether you are a seasoned statutory auditor mapping out the risk areas for your next major group engagement, or a finance controller navigating the really turbulent waters of corporate reporting, or even a CA student eager to understand how these abstract standards actually bite in the real world, you are definitely in the right place.
Because our mission here isn't just to read the rule book to you.
Right. The mission is to extract the most vital insights from complex, real-world accounting case studies. We want to give you a shortcut to being deeply well-informed. We are here to decode the underlying mechanics of financial reporting.
Exactly. Because, the value of these standards isn't just in memorizing the paragraph numbers, right? It's in understanding the philosophy behind them. Like, why does the standard demand a certain treatment, and how does that treatment physically alter the financial statements?
That is where the true expertise lies. Yes.
So let's unpack this. Our focal point today is a highly specific, totally fascinating case study. It feels like a classic corporate drama, honestly. We are examining an Indian company, let's just call them Company A for our purposes.
Okay, Company A.
Yeah. And they operate heavily in the construction business, taking on these long-term, complex infrastructure projects. But crucially, they are a component. They are a local subsidiary of a massive international group.
Right, which changes the dynamic completely. Right. And up until this very moment, Company A has been recognizing the revenue from its construction contracts using what is widely known as the output method.
Which, I should add, is an incredibly robust and common approach, particularly in the Indian construction sector, where physical milestones are often strictly certified by third parties.
Yeah, it's very standard. But then comes the mandate from Global HQ. The international parent group has decided, for its own consolidated reporting purposes, to switch its global revenue recognition policy to the input method.
Ah, okay. I see where this is going.
Yeah. Consequently, the leadership at our local Indian component, Company A, looks at this and decides, well, the parent group is doing it. We need to consolidate our numbers with theirs anyway. It's just easier if we fall in line and switch our standalone financials to the input method too.
The path of least resistance.
Exactly. And on the surface, this feels like standard corporate synergy, right? But it actually opens up this whole labyrinth of accounting and audit complexities.
A labyrinth is honestly the perfect word for it, because they aren't just changing a spreadsheet formula. I mean, they are altering the fundamental measurement basis of their primary revenue stream.
Right.
And the cascade of accounting implications is profound. Most management teams, they don't fully anticipate the blast radius until the statutory auditors step in and start asking the really difficult questions.
Which perfectly sets the stage for the three core questions driving our deep dive today. First is the phrase, the group is doing it. Actually a valid, standalone justification for an Indian component to switch its accounting methods under Ind AS.
A very common justification, but is it valid?
Right, right. Second, if Company A does go through with this switch, how is it classified within the financial statements?
Right.
Is it a simple change in accounting estimate, or does it cross the line into a change in accounting policy?
Huge distinction there.
Massive.
Yeah.
And third, the most mechanically daunting question. Exactly how does a company practically account for this monumental shift in their books, and what are the retroactive consequences?
Well, before we dissect those questions, we absolutely must establish the baseline parameters of the environment Company A is operating within.
Right, lays the ground rules.
Because we are analyzing an Indian component entity, the functional and presentation currency for everything we discussed today is strictly the Indian rupee, the INR.
Okay, INR.
Got it. Furthermore, the reporting period we are evaluating runs on the standard Indian financial year, so that's from the 1st of April to the 31st of March.
Right.
And these might seem like just basic administrative details, but as we delve into the mechanics of group reporting versus local reporting, that INR environment and that specific April to March timeline become the critical friction points.
I am really glad we laid those ground rules. The local environment is everything in this case. So let's jump straight into the first dilemma. Let's call it the parent company said so defense.
I like that. The parent company said so defense.
Right. You get the memo from global headquarters.
Huh?
They are migrating to the input method globally. You are a wholly owned subsidiary. You rely on their global ERP system. Do you just say, yes, boss, and implement the change?
The short, definitive answer from an Ind AS perspective is no.
Just flat no.
Flat no. Simply aligning with a global group policy is not, in and of itself, a valid accounting reason to change from the output method to the input method of measuring progress for your local standalone financial statements.
Okay, I have to play the devil's advocate here because I know exactly what every single CFO listening to this is thinking right now.
Go for it.
Shouldn't a global multinational group have matching books? I mean, if I have the parent company sitting in London and I'm consolidating the financial results of 50 different subsidiaries spread across the globe, I desperately want everyone speaking the exact same accounting language.
Sure, administratively that makes sense.
Right. If I have 50 different subsidiaries using 50 different methods to measure construction progress, my consolidated financial statements are going to be an unreadable mess. So if the parent company changes the rules of the house for the sake of global uniformity, shouldn't the local kids naturally follow suit? From a corporate governance and internal control standpoint, it just seems like basic common sense.
It makes absolute sense from a purely administrative and logistical perspective. You are completely right about that. Group controllers want uniformity to make consolidation seamless.
Exactly.
But here's the critical distinction we have to make. Indian accounting standards do not exist merely to make the consolidation process easy for a foreign parent company's finance team.
Right. That's not their purpose.
Not at all. The standards exist to ensure that the standalone financial statements present a true, fair, and objective view of the underlying economic reality of that specific entity.
Okay. So the component standalone books are an independent ecosystem. They aren't just like a rough draft for the parent's consolidated report.
Precisely. What's vital to understand here is the concept of the reporting entity itself. Company A, as an Indian registered company, is its own reporting entity. It has its own statutory obligations to Indian regulators, to Indian tax authorities, and to local stakeholders.
Right.
So while the global group is making a macro-level change, the local component cannot just blindly adopt it as a rubber stamp compliance exercise. They must independently evaluate the underlying reason for the change through the lens of their own operations.
So they have to do their own homework. They can't just copy the parent company's test paper and hope the local statutory auditor doesn't notice.
That's a really good way to put it. The management of Company A must rigorously evaluate their own objective reality. They have to ask a very pointed question. Is the input method actually the most appropriate method for faithfully depicting the transfer of control for our specific performance obligations executed right here in India under these specific local contracts?
And what if they do that homework? What if they look at their local reality and say, you know what, the parent company mandated this, but after reviewing our supply chains and our specific contract structures, the input method actually does make sense for us too.
Okay, if and only if after a thorough, independent, and documented evaluation, they determine that the economic rationale for the change is sound and it genuinely fits the component's local reality better than the output method, then they were permitted to change it.
But the reasoning has to be local.
Exactly. The fundamental justification provided to the statutory auditor must be rooted entirely in their own local operations, local contract terms, and local performance patterns. A directive from headquarters is a catalyst to investigate. It is never the justification to change.
That distinction between a catalyst and a justification is so powerful. It's about maintaining autonomy and accuracy at the local level.
Or,
But to truly grasp how a company makes that independent assessment,
Mhm.
we need to open the rule book and look at the underlying mechanics. So let's bring in Ind AS 115. That's the standard governing revenue from contracts with customers. This is where the actual rules for measuring progress over time live.
Yes. We specifically need to dissect paragraphs 39 through 41 of Ind AS 115. These paragraphs form the absolute bedrock of how any entity, whether it's a construction firm, an IT services provider, or, I don't know, an aerospace manufacturer, recognizes revenue when a performance obligation is satisfied over a period of time rather than at a single point in time.
Let's start with the foundational philosophy in paragraph 39. So, looking at the text, the underlying philosophy seems to be entirely focused on this concept of the transfer of control.
Yes.
The standard basically states that an entity must recognize revenue over time by measuring the progress towards complete satisfaction of that performance obligation. The entire objective is to accurately depict the entity's performance in transferring control of goods or services to the customer. So, it almost feels like the standard doesn't actually care how hard the company works or how much money they've spent. It only cares about what the customer actually possesses or benefits from at any given moment. Am I interpreting that intent correctly?
You have hit the nail squarely on the head. And AS 115 was a massive paradigm shift precisely because of this intense focus on the transfer of control.
Right, because older standards were different.
Very different. Under older standards, there was often a much heavier emphasis on the transfer of risks and rewards, or simply matching revenues to costs incurred. But NES 115 asks a singular, very focused question. When does the customer gain the ability to direct the use of and obtain substantially all of the remaining benefits from the asset being created?
Okay, let's make that concrete.
Sure. Let's say you are building a bridge for a municipal government. You don't recognize revenue just because you poured 1,000,000 rupees worth of concrete.
Right, because pouring concrete isn't the goal.
Exactly. You recognize revenue because the government now effectively controls a partially built bridge that has increased in value. Your measurement of progress must faithfully depict that specific transfer of control.
Which perfectly sets up paragraph 41, because if the goal is to measure that transfer of control, you need a tape measure, right? And paragraph 41 explicitly states that both output methods and input methods are appropriate ways to measure this progress. But, and this is key, it's not a free choice, is it?
Not at all. It's not a buffet. Paragraph 41 makes it very clear that the choice between an input or an output method depends entirely on the nature of the good or service promised to the customer. You must select the method that most faithfully depicts the transfer of control based on the specific facts and circumstances of the contract.
Let's ground this for our listeners with some actual mechanics. Let's talk about the output method first. This method is essentially looking at the direct results achieved, right? It's measuring the value of the goods or services transferred to date relative to the remaining goods or services promised.
Exactly. Output methods include things like surveys of performance completed to date, appraisals of results achieved, milestones reached, time elapsed, or units produced.
Right.
In the Indian construction context, this is incredibly prevalent. Think of a commercial real estate project. The output method often relies on physical certifications by an independent architect or a project management consultant.
Oh, right, like the architect goes to the site.
Yes, the architect surveys the site and formally certifies, yes, the foundation is 100% complete and the superstructure is 20% complete.
And based on that physical certified milestone, which represents actual tangible value transferred to the client, the company recognizes a proportional amount of revenue. It's very objective. It's based on what you can physically see and touch.
Yes, exactly. Now contrast that with the input method. Input methods recognize revenue on the basis of the entity's efforts or inputs to the satisfaction of a performance obligation.
Okay.
This includes resources consumed, labor hours expended, costs incurred, or machine hours used relative to the total expected inputs to satisfy that obligation.
So the input method is essentially saying, all right, we estimate this entire project will cost us 100,000 labor hours and 10,000 tons of steel. At the end of this reporting period, we have used 20,000 labor hours and 2,000 tons of steel. Since we have consumed 20% of our expected total inputs, we will just assume we have transferred 20% of control to the customer, and we will recognize 20% of the total contract revenue.
That is the mechanical essence of the cost-to-cost input method, yes. But, and here is the critical vulnerability of the input method, there must be a direct relationship between your inputs and the transfer of control to the customer.
What do you mean by direct relationship?
Well, if an entity incurs significant costs that do not contribute to an entity's progress, for example, a massive amount of wasted materials due to a flood on the construction site, or maybe severe inefficiencies in labor, those costs do not represent control transferring to the customer.
Oh, wow.
You
Yeah,
cannot recognize revenue on wasted materials just because you spent the money. The customer doesn't care that your materials washed away.
that makes perfect sense. The customer isn't getting a better building just because your crane operator was terribly inefficient or your cement got ruined in the monsoon. So if your inputs are highly volatile or prone to inefficiencies, the input method might drastically distort the actual progress of the project.
Precisely. It creates a false picture of progress. And this is exactly why the evaluation of which method to use is so rigorous. Which brings us to the consistency mandate in paragraph 40 of Ind AS 115.
Right, paragraph 40.
This is the structural framework that governs the choice once you've made it. What's fascinating here is how strict it is.
What does paragraph 40 actually require?
It requires an entity to apply a single method of measuring progress for each performance obligation.
So no mixing and matching.
Exactly. You cannot mix and match to smooth your earnings. You cannot use the input method for the excavation phase because costs are high, and then switch to the output method for the finishing phase because milestones are easier to certify. One performance obligation, one single method.
That strictly prevents cherry picking to hit financial targets.
It does, but it goes further than that. Paragraph 40 mandates that this single method must be applied consistently to similar performance obligations and in similar circumstances. It must be remeasured at the end of each reporting period, which, for our company A, is ending March 31st.
Okay, let me pause you right there, because this is where the corporate drama gets really, really intense.
Let's hear it.
I want to play the role of the aggressive global CFO again. So I read paragraph 40. It says I need a single method for similar obligations on a consistent basis in similar circumstances.
Right.
So I look at my global empire. I say, look, company A in India is building a commercial office tower. Company B in Germany is also building a commercial office tower. They are identical structural designs. These are incredibly similar performance obligations. Therefore, to comply with the consistency mandate of paragraph 40, I am actually required to force company A to use the same input method that company B is using in Germany. I'm just ensuring a single method across similar obligations across my consolidated group.
Boom. It sounds convincing.
Right. The standard isn't just allowing me to enforce global uniformity, it's practically demanding it. How do you argue against that logic?
It is a remarkably clever argument, and honestly, it is the exact trap that highly centralized finance teams fall into when they are trying to bulldoze local accounting policies. But the argument relies on a fatal flaw in reading comprehension.
Oh, really? What did I miss?
You have correctly identified that the obligations are similar. Building a commercial tower is building a commercial tower. However, you have completely ignored the second half of the requirement in paragraph 40. They must be in similar circumstances.
Similar circumstances. The classic danger of stopping halfway through an accounting sentence.
Exactly. You cannot conflate the physical nature of the work with the economic and legal environment in which the work is executed. Yes, the performance obligations of the international group and the Indian component are similar, but the circumstances in which they are executing those obligations are vastly, fundamentally different.
I want to really dig into this. What exactly constitutes differing circumstances in the context of Ind AS 115? Like, what makes the reality of building a structure in Mumbai so different from building one in Munich from a purely revenue measurement perspective? Because to a layperson, pouring concrete is pouring concrete.
It comes down to vital, highly localized variables: geography, the law of the land, regulatory frameworks, and commonly accepted business practices. Let's take the Indian context specifically.
Okay.
Company A operates under entirely different local laws than its German counterpart. In India, real estate and construction are heavily regulated by the Real Estate Regulation and Development Act, commonly known as RRA.
Right. RARI is huge in India.
It dictates strict norms for how developers can collect funds from buyers, often tying collections directly to physical, architect-certified milestones.
Okay, so if you are building a residential complex in India, our ERA might say you cannot demand the next tranche of payment from the buyer until the local municipal authority or a registered architect officially certifies that, say, the fifth floor slab is complete. That is a hard, legally binding output milestone.
Exactly. You literally cannot bill the customer without that milestone. Furthermore, look at the taxation structure. India operates on the goods and services tax, the GST regime.
Right.
The timing of invoicing, the claiming of input tax credits, and the point of taxation under GST are intricately tied to the physical progress of services and the issuance of milestone invoices. Then you have local labor laws, the use of unorganized subcontractors versus direct payroll, and the volatility of local supply chains.
And we established our baseline earlier. They are dealing entirely in the Indian rupee, so they are subject to Indian inflation rates, local commodity price fluctuations for things like steel and cement, and local financing costs.
All of these factors combine to create a deeply unique set of circumstances. Because of RERA, because of GST and standard Indian contracting practices, a construction contract in India often has very rigid, highly reliable milestone certifications built right into the legal framework of the deal.
Right.
In this specific environment, the output method is often exceptionally reliable. It faithfully depicts the transfer of control because the legal transfer of value is tied directly to those physical milestones.
But let's look at the parent company. Their environment is totally different.
Right. Meanwhile, the parent company in Europe or North America might operate in an environment where cost-plus contracts are the industry standard, where labor rates are highly stable, and where raw material inputs are perfectly hedged against inflation.
Oh, interesting.
In their circumstances, measuring the inputs the costs incurred might actually be a highly accurate proxy for the transfer of control.
So if the global headquarters forces Company A to adopt the input method, they aren't achieving consistency at all. They're actually overriding the local economic reality. They're ignoring the fact that in India, measuring inputs might be completely distorted by monsoon delays, localized supply chain shocks, and complex GST credit reconciliations.
Precisely. By forcing a single method across the entire global group, irrespective of these wildly differing local circumstances, the parent company is essentially directing the subsidiary to violate Ind AS 115.
Wow.
You cannot enforce a global accounting monopoly if the local statutory realities do not support it. The requirement for consistency applies to similar circumstances. India and Europe, in the context of construction execution, are rarely similar circumstances.
But what does this all mean? That brings us to a really clear conclusion on our first question. For the CFO of Company A, it means their absolute first duty is to the standalone financial statements. They must look at their own objective for measuring progress under paragraph 39. They must evaluate their own local contracts, their own local laws, and make a judgment completely independent of the parent's mandate. The global memo is just noise until it is validated against the local reality.
That is the core takeaway. The statutory auditor for Company A is not auditing the global group. They are auditing Company A.
Right.
If Company A switches to the input method, the auditor will demand documentation proving why the input method is the most faithful depiction of the transfer of control in India, because headquarters told us to, will absolutely result in a qualified audit opinion.
Nobody wants a qualified opinion.
Definitely.
Okay, so let's move the timeline forward. Let's assume the local finance team does the rigorous work. They map out their local contracts, they analyze their supply chains, they look at how control transfers to their specific clients, and they legitimately conclude, you know what? Even though our local environment is different, given the specific nature of these new contracts we've signed, the input method actually is a better representation of how we transfer control over time. The parent company's reasoning was flawed, but their conclusion actually works for us.
Okay, so they've independently justified it.
Right. So the Indian management team decides to independently authorize the change from the output method to the input method. This brings us to the second major question, which is essentially an identity crisis for the financial statements.
An identity crisis. I love that framing.
When you change how you measure your revenue halfway through a contract, what do we actually call this change in the books? Are we simply updating a change in an accounting estimate, or are we fundamentally altering a change in an accounting policy?
And this distinction is not merely academic. It dictates the entire mechanical treatment of the change. To answer it, we have to leave the revenue standard for a moment and open up Ind AS 8, which is the standard dealing specifically with accounting policies, changes in accounting estimates, and errors.
Ind AS 8. That's one of those standards that just operates quietly in the background until something goes horribly wrong, and then suddenly becomes the most important document in the room.
Absolutely. It is the rule book for fixing things. Let's break down the definitions in paragraph 5 of Ind AS 8 first. It defines accounting estimates as monetary amounts in financial statements that are subject to measurement uncertainty.
Okay, let's unpack measurement uncertainty. An estimate is basically management's best educated guess when perfect information just doesn't exist yet, right?
Right.
For example, estimating the provision for expected credit losses. You don't know exactly which customers will default, so you use historical data to estimate a percentage. Or, like, estimating the useful life of heavy construction machinery. You assume the bulldozer will last for 10,000 working hours, but maybe the terrain is harsher than expected and it only lasts 8,000.
That is exactly right. Estimates involve judgments based on the latest available, reliable information. And because they are based on the latest information, they naturally change as new information becomes available. If a major customer goes bankrupt, your estimate for credit losses changes.
Right. It adapts to new facts. So if we look at the input method, there are estimates involved there, right?
Yes, heavily.
You have to estimate the total expected cost of the project to calculate your percentage of completion. If the price of steel suddenly skyrockets due to global tariffs, your total expected costs increase, which obviously changes your percentage of completion.
Yes. Changes in the estimated total costs or estimated total revenues of a contract are classic changes in accounting estimates. But, and this is crucial, that is not what Company A is doing here. They aren't just updating the variables inside the formula, they are changing the formula itself.
Okay, I have a way to visualize this. Tell me if this analogy holds up.
Let's hear it.
Let's step away from construction and imagine I run a large retail warehouse. If I walk into the warehouse at the end of the year and recount my inventory because I discovered a pallet of missing boxes hidden behind a forklift, I'm adjusting my numbers based on new physical information. That is a change in an estimate based on a new event.
Okay, agreed.
However, if I decide to change the fundamental economic formula for how I value every single item in that warehouse, say, moving from a first in, first out, or FIFO valuation to a weighted average cost valuation that feels entirely different, I haven't discovered new boxes. I'm just choosing to look at the exact same physical reality through a completely different financial lens. That feels like changing the rules of the game. That's a policy change. It's changing from the output to the input method, similar to changing the inventory valuation formula.
That is an exceptional analogy, and it lines perfectly with the standard. Changing from FIFO to weighted average is changing the measurement basis. Now, look at paragraph 35 of Ind AS 8.
What does it say?
It explicitly states that a change in the measurement basis applied is a change in an accounting policy and is not a change in an accounting estimate.
Ah, and Ind AS 8 defines accounting policies as the specific principles, bases, conventions, rules, and practices applied by an entity in preparing and presenting financial statements.
Exactly. Now, paragraph 35 does add a pragmatic caveat. It says that when it is genuinely difficult to distinguish a change in an accounting policy from a change in an accounting estimate, the change is treated as a change in an accounting estimate.
Like a tiebreaker.
Yes, it is a fallback provision for gray areas. But I can assure you, in the case of Company A switching revenue recognition methods, there is no gray area. It is not difficult to distinguish.
Why is it so black and white in this specific scenario?
Think back to your warehouse analogy. A change in an accounting estimate happens because of new information, new events, or new developments. The missing boxes were a new development. But with Company A, look at the underlying reality. The performance obligation, the contract to build the commercial tower in Mumbai, remains exactly the same.
Right.
The architectural plans haven't changed, the customer hasn't changed, the legal terms haven't changed.
So there is no new event that suddenly renders the output method mechanically broken.
None whatsoever. You are simply changing the measurement basis, the conceptual framework for how you recognize revenue over the life of that exact same contract.
Oh.
You are changing the fundamental rules applied to the transaction. Therefore, it is definitively a change in an accounting policy, and it cannot be brushed off as a mere update to an estimate.
Okay, so it's a change in an accounting policy. I feel like the CFO might hear that and say, fine, it's a policy change. That doesn't sound too bad. We just draft a new policy manual, write a nice descriptive disclosure note in the annual report explaining our new philosophy, apply the input method going forward, and move on with our lives. It feels like an administrative victory.
And this brings us to the most dangerous misconception in corporate reporting, which leads us to a massive plot twist in our analysis.
The plot twist.
Yes. Is a change in accounting policy regarding revenue recognition actually an open choice that management can make at will?
Uh-oh. When an auditor asks a rhetorical question like that, the answer is usually terrifying. Let me guess. You can't just wake up on April 1st and say, I feel like being an input method company this financial year.
You absolutely cannot. And the reasoning requires us to synthesize everything we've discussed about Ind AS 115 and Ind AS 8. Remember the consistency mandate.
Right, from para 40.
Ind AS 115 requires you to make a considered judgment on the appropriate method, input, or output based on the nature of the goods and services, and then apply it consistently to similar obligations in similar circumstances. It is not a free-for-all menu.
Right. You evaluate the circumstances, you pick the method that faithfully depicts the transfer of control, and you lock it in.
Precisely. The selection of the method was a fundamental accounting policy choice made initially at the inception of the contract. You looked at the facts, you applied the standard, and you chose the output method. Now, years into the contract, the circumstances haven't changed, the obligations haven't changed, but you suddenly want to change the policy.
Wait, so if the reality hasn't changed, but you were changing the lens, what does that imply about the original lens you were using?
It implies that the original lens was wrong. Changing the policy for a given performance obligation in similar circumstances is not a casual update. It is classified by the standards as a rectification of a prior period error.
Whoa, wait a minute. A prior period error. That is a massive escalation. That is a highly loaded term in the accounting world. You are saying that by voluntarily changing our accounting policy today, we are effectively self-reporting that our audited financial statements from the past few years were fundamentally flawed.
Let's look at the strict, unyielding definition in Ind AS 8, paragraph 5. It defines prior period errors as omissions from or misstatements in the entity's financial statements for one or more prior periods. And here is the critical diagnostic criteria. These errors arise from a failure to use or misuse of reliable information that was available when those financial statements were approved for issue and could reasonably have been expected to have been obtained and taken into account.
Okay, let's dissect that. Failure to use reliable information that was available. So an error isn't just like a typo in a spreadsheet. It's not just a math mistake. It's failing to properly analyze the information you had access to at the time.
And Ind AS 8 explicitly clarifies that such errors include the effects of mathematical mistakes, mistakes in applying accounting policies, oversights, or misinterpretations of facts.
Mistakes in applying accounting policies. That is the kill shot right there.
Yeah.
So let's connect the logic for Company A. If the CFO of Company A stands before the audit committee today and says, we are changing from the output method to the input method because we have determined that the input method is the most faithful depiction of the transfer of control for this ongoing contract.
Then the audit committee must logically conclude the following. Since the contract terms are the same and the local Indian circumstances are the same, if the input method is the only correct way to faithfully depict control today, then it must have been the only correct way to depict control 2 years ago when the contract started.
Oh, man. I see the trap.
Yes. By deciding to change it now without any change in underlying circumstances, management is formally admitting that they misinterpreted the facts and failed to use the available reliable information to select the correct accounting policy in the prior periods. They are admitting that the revenue recognized under the output method in previous years was a misstatement. Therefore, this policy change is, by definition, the correction of a prior period error.
That is a staggering paradigm shift. I mean, the psychology of this is fascinating. What started as an attempt by a local finance team to simply comply with a directive from global headquarters, let's just align the books and keep London happy, has suddenly morphed into a scenario where the local CFO has to declare to their shareholders, their regulators, and the tax authorities that their historical financial reporting was erroneous.
It transforms a forward-looking administrative alignment into a backward-looking compliance nightmare, and declaring an error is just the beginning. The accounting mechanics required to fix a prior period error are incredibly severe.
Which brings us to the operational reality of this decision. If I'm the finance controller for Company A, sitting at my desk in April, trying to finalize the standalone books for the financial year ending March 31st, and management formally accepts that this switch is a prior period error, what is my actual physical workload? Like, how on earth do we account for this?
I hope you have a large team and a lot of coffee, because paragraph 42 of Ind AS 8 dictates a process called retrospective restatement. The standard states that an entity must correct material prior period errors retrospectively in the first set of financial statements approved for issue after their discovery.
Retrospective restatement. It's literally the accounting equivalent of a time machine. You don't just fix it today. You have to go back and rewrite history as if the error never occurred.
Exactly. You must restate the comparative amounts for the prior period or periods presented in which the error occurred.
Let's visualize this practically.
Yeah.
So, I am preparing my financial statements for the current year ending March 31st, 2024. In my annual report, I have to show a comparative column for the previous year ending March 31st, 2023. You are telling me I cannot just publish the 2023 numbers as they were historically audited and approved by the shareholders last year.
No, you absolutely cannot. Those historical numbers were based on the output method, which you have now declared an error. You have to completely strip out the revenue and cost of goods sold recognized under the output method for 2023. You must then dig through your historical project data, calculate the percentage of completion using the input method based on costs incurred back in 2023, and recalculate the 2023 revenue and margins from scratch.
That sounds difficult, but maybe manageable for a single year. But what if this construction contract has been running for 4 years? What if the error originated back in the financial year ending March 31st, 2021? That is before the earliest prior period presented in my current 2024 financials.
This is where it becomes an operational nightmare. If the error occurred before the earliest prior period presented, Ind AS 8 requires you to restate the opening balances of assets, liabilities, and equity for the earliest prior period presented.
Let's walk through the journal entries of that nightmare. To fix the opening balance of equity for April 1st, 2022, I have to go back and recalculate the input method revenue for FY21 and FY22. I have to figure out exactly how much steel, cement, and labor was consumed in those specific historical windows, which might be incredibly difficult to verify now.
Is notoriously difficult because remember, during FY21 and FY22, your accounting systems and your site engineers were heavily focused on tracking RERE milestones and architect certificates for the output method.
Right, they weren't looking at inputs.
Exactly. They might not have been meticulously tracking the allocation of overhead costs or raw material inputs with the level of precision required to drive your primary revenue recognition formula. You are trying to extract high-fidelity data from a system that wasn't designed to prioritize it.
And think about the statutory auditor. The auditor has to provide an opinion on these restated numbers. How does an auditor find sufficient appropriate audit evidence for a measurement basis that the client wasn't even actively utilizing 3 years ago?
It requires extensive substantive testing, digging through physical invoices, re-verifying labor muster rolls from years past, and potentially dealing with massive, massive data gaps.
But the complexity doesn't stop at the revenue line, does it? I mean, if I change my revenue for 2021 and 2022 retrospectively, I am altering my historical profit before tax, which means my historical income tax calculations were wrong.
Absolutely. The retrospective restatement triggers a massive deferred tax reconciliation. You have filed your actual corporate income tax returns with the Indian tax authorities based on the output method profits. Now your books are showing a completely different profit profile based on the input method.
Right.
This creates temporary differences that will ripple through your deferred tax assets and deferred tax liabilities, requiring complex recalculations of the opening retained earnings net of tax impacts.
And what about GST? If we recognize revenue differently over time, does that impact our historical GST compliance?
While GST is generally driven by invoicing and the time of supply rules rather than accounting revenue recognition, a massive disconnect between your audited financial revenue and your GST turnover will immediately trigger reconciliations and potential scrutiny from the indirect tax authorities during assessments. You have to maintain detailed reconciliation statements explaining why the revenue in your books no longer matches the revenue on your historical GS2 returns.
So, just to summarize the mechanics here, you are unearthing years of dead data, forcing a new mathematical framework onto it, altering your historical tax positions, and adjusting the fundamental opening balance of your company's equity. And remember our baseline rule. This all has to be executed within the notoriously tight statutory reporting deadlines of the Indian corporate ecosystem, racing toward that March 31st closing.
And you cannot do this quietly. You don't just change the numbers and hope nobody notices. The standard demands absolute transparency when fixing an error.
All right, paragraph 49 of Ind AS 8, the disclosure requirements.
Yes. Paragraph 49 mandates that an entity must disclose the nature of the prior period error. You must disclose, for each prior period presented, the exact amount of the correction for each financial statement line item affected. If you restated opening retained earnings, you must disclose the exact amount of that adjustment at the beginning of the earliest prior period presented.
So you are basically putting a massive, unavoidable spotlight in your annual report that says, "Dear shareholders and regulators, we fundamentally misunderstood our own business model and misapplied accounting standards for the last 3 years, and here's exactly how many millions of rupees we were off by."
Which circles us all the way back to the CFO's inbox in Mumbai. This is precisely why a local component entity must never simply change its accounting measurement basis just because the international parent company sent an email requesting global alignment. The downstream consequences, admitting to a prior period error, triggering a grueling retrospective restatement, dealing with complex tax mismatches, and making highly visible public disclosures of failure are far too severe to undertake lightly.
The juice is absolutely not worth the squeeze unless the original method was genuinely, demonstrably failing to present a true and fair view of the local reality.
Exactly. The integrity of the local financial statements must always take precedence over the administrative convenience of the global consolidation team.
Before we wrap up with our final thoughts on the broader implications of this case, we have some important housekeeping and some honestly incredible resources to share with our audience. Because the deep mechanical insight we explored today didn't just come out of thin air. This specific issue, the complex tension between global mandates, the input-output dilemma under Ind AS 115, and the trap of prior period errors under Ind AS 8, was featured in the 224th edition of the Gap Advisors Task Weekly newsletter.
It is an exceptional publication. It takes the dry, theoretical text of the accounting standards and really applies them to the messy, contradictory reality of corporate operations.
Absolutely. The newsletter is authored by C.A. Manish C. Iyer, the director of Gap Advisors, and it is published regularly on LinkedIn. If you're an accounting professional, it is a must-read. They have published over 230 editions till date, consistently tackling these exact kinds of complex, real-world accounting knots.
The depth of analysis provided in those editions is exactly why we wanted to bring this specific case study to our audience today.
And the resources available to you go far beyond just the newsletter. I want to highlight something truly massive for our listeners. The issue we discussed today originates directly from the incredible issue repository on the Gap Advisors website, which you can find at https://gapadvisors.com. Listen to this scale. The repository hosts over 4,500 highly specific issues and detailed responses focused entirely on Ind AS and Indian GAAP.
4,500 real-world issues. That is a staggering library of practical accounting precedent.
It really is a goldmine. And the best part is the accessibility. Any person can register for free on https://gapadvisors.com. Once you're registered, you aren't just limited to reading past issues. You can actively submit your own complex issues and scenarios regarding Ind AS and Indian GAAP, and you will receive a detailed, well-researched response delivered directly to the inbox of the email of that person registered with https://gapadvisors.com.
That is extremely helpful.
Right. I cannot emphasize enough how helpful this platform is, particularly for auditors who need to document how they addressed any issue on application of Ind AS. When you are in the trenches of an audit, arguing with management over the interpretation of similar circumstances, you need concrete, reliable documentation. Having access to a repository of over 4,500 resolved cases is like having an expert technical desk right at your fingertips.
It is an invaluable tool for maintaining the integrity of financial reporting and ensuring rigorous compliance across the profession.
Now, a necessary and important disclaimer. We must explicitly mention that the views expressed herein are the personal views of the author, C.A. Manish C. Iyer, and are not binding on the audience. Every company's financial ecosystem is unique, with highly specific variables. Therefore, the audience is requested to seek the help of an expert before any action or refraining from any action based on the views discussed herein today.
Always consult with your own professional advisors and statutory auditors when applying these complex standards to your specific facts and circumstances.
Thank you so much for your time today and for your continued dedication to learning and mastering the intricacies of financial reporting. If you found today's exploration valuable, we kindly request that you follow or subscribe to the Gap Advisors Ind AS Clinic podcasts on Spotify, Amazon Music, and YouTube, whichever you prefer to listen to Gap Advisors Ind AS Clinic podcasts on.
And please don't keep this knowledge to yourself.
Yes. We strongly request that you share this among your contacts, colleagues, audit and finance teams, and especially students pursuing their CA course to spread the knowledge on the application of Indian accounting standards. Elevating the competence of the profession helps everyone.
If we connect all of this to the bigger picture, analyzing this case study leaves me with a very provocative thought about the global financial system.
Oh, what's that?
Well, we just spent an hour detailing how incredibly difficult and perilous it is for a local subsidiary to change its accounting policies just to satisfy a corporate mandate from a parent company. We've seen how forcing the input method in India, when local circumstances like RERA and GST favor the output method, not only violates Ind AS 115, but triggers massive retrospective errors under Ind AS 8.
Right, it's an absolute accounting minefield.
So here is the question for our listeners to mull over. Given the intense pressure that multinational headquarters place on local finance teams to achieve global uniformity and rapid consolidation, how much true objective autonomy do local component entities actually have?
That's a great question.
When you look at the consolidated financial statements of a massive global conglomerate, how confident are you that the numbers reflect the true economic reality of every local jurisdiction? Or, conversely, how often are those polished global consolidated financials secretly masking hundreds of localized accounting errors that were born entirely out of forced corporate compliance overriding local statutory reality?
That is a chilling thought for an auditor. It makes you wonder how many spreadsheets out there are quietly hiding Ind AS 115 and Ind AS 8 violations just to keep the global consolidation software in London or New York happy. It fundamentally questions the integrity of top-down global accounting mandates.
It highlights the vital importance of the local statutory auditor standing their ground and demanding fidelity to the local economic truth.
It certainly gives us all something profound to look out for during the next audit cycle. Until next time, keep questioning the memos from headquarters, keep digging into the mechanics of the standards, and always respect the local reality. Thank you for joining us.